Hi, I'm Batu from freefincal. On this video, I'm going to talk about Franklin India Ultra Short Term Bond Fund. This has been the darling of many investors in the recent few years. Many people like its high returns and they like the fact that it has somehow escaped from major credit problems. So, I want to talk about how risky the fund actually is, who should invest in this fund, and how to invest in it. So when you look at these snapshots from value research from the funds page, they look very enticing. You have a 5-star rating, the NAV looks nice and smooth. Then you look at the annual returns, they are never less than 8.5%. They're actually more than that. It looks very inviting to invest in this kind of fund. But please recognize that there are a lot of risks involved, and the fund management has done a wonderful job of handling these risks so far, but that doesn't mean they will get it right all the time, and they do not get it right all the time is what I want to show in this video. So the first thing is the name. It's got a very strange name, Franklin Ultra Short Term Bond Super Institutional Plan. This doesn't mean institutions only should invest. Retail investors can also invest, but if for a lump sum, the minimum amount is 10,000. For SIP, it's 1,000 rupees. The problem started when SEBI wanted the fund houses to merge the retail plan and the institutional plan, and then the fund house stuck to this name. I don't know why. So if you look at the AUM of this fund, the regular option has the regular plan growth option has got 53.86% of the total AUM. The direct plan has got 30% of the AUM, 30.7% of the AUM, 8.5% of the AUM is in daily dividend option for regular, 3.8% in weekly dividend option, 2% is in daily dividend direct, and 0.8% is in weekly dividends. We'll talk about the dividend investing option later. So how is this fund? Okay, so let's look at let's not go to that first. Let's not talk about the management yet. So when you go to a credit fund page, the first thing you should look at is the yield to maturity of the fund. This yield to maturity is 9.7671 currently. Last 1 year it was 9.96, the highest, and the lowest was 9.20. So it has been above 9 for the last year or so. And when you look at the last 1 year FD returns, this is at least almost 2%, almost 2% above the SBI FD return for 1 year or so. That tells you that this fund is taking a huge amount of risk. Yield to maturity is not a measure of return. It is not a measure of. It is a measure of risk. Yield to maturity definition is if the fund manager held those bonds until maturity, then that's the kind of return an investor will get. But that is not valid for an open-ended fund completely, because the fund will have inflows and outflows. The fund manager will change the weights of the bond. They will buy and sell new bonds. When that happens, the yield to maturity will keep fluctuating on a daily basis. So this is completely wrong. It is an indicator of risk and not reward. Please don't make that mistake. The second thing is look at the modified duration. The modified duration is 0.47, the high was 0.5 and the low was 0.39. This tells you that when there is a 1% change in the interest rate, the NAV can move up or down by about 0.4% or so. That's what the modified duration is. That's a measure of interest rate risk. Then you look at the average maturity of the bond. It's about 0.6, somewhere between 0.5 to 0.6 years. Of course, that's not. That doesn't mean you can invest for 0.6 years. That is for half a year or 6 months or 7 months and so on. Don't make that mistake. You should not use this fund for less than 1 year. Use it for preferably for more than 1 year. Minimum is 1 year. I will show you another graph why that is the case. So. Why is this fund able to manage risk so well? Look at the number of bonds that it's holding. It currently holds 136 bonds. The category average is only 47 bonds. And in the last year, it has always had more than 1 year bond. So, and also, I forgot to point out the yield to maturity category average is 7.8%, while this fund has got about 9. So that tells you it's extremely risky compared to the category. And so the number of bonds, because it takes so much of risk. In order to manage the risk compared to the category of about close to 50 bonds, this fund has got double the number of bonds, so that the individual exposure to each bond is low, and that's the main way they handle credit risk. And they have a very well diversified portfolio that they can handle and manage the credit risk so far. That doesn't mean they get it right all the time. That is not true. But so let me come back to this graph. So one more, let me just come back. I forgot to. Okay. So these are month to month bond downgrades. From July 2019 to August 2019, 6 bonds in the portfolio have been downgraded. From June 2019 to July 2019, another 6 bonds have been downgraded. From May to June, about four bonds have been downgraded, 2 bonds have been upgraded. From May to, sorry, I think I got it wrong. I think April to March, I think I said some mistake here. There are upgrades from April to March, and January to February there's one downgrade and so on. So upgrades and downgrades are part and parcel of mutual fund investing, debt mutual fund investing in particular. And yeah, so please don't assume that fund management is doing a great job. It never has faced a bond downgrade and so on. Bond downgrades have been faced. They have been able to manage because they have so many bonds from different areas, and many of them are high. The yield is high. That is, their credit rating is low. Even if one or two of them fail, they are still able to manage the overall return of the portfolio. That's how they have been managing. And now if I go back to it, one question people ask is, but the NAV is nicely smooth and increasing. It is not. It's quite volatile. If you look at the standard deviation of this fund, this is about 0.60 compared to the CCIL T-bill liquidity weight. This is not the benchmark of the same, but it's closely related. So it's about almost 3 times more volatile than this benchmark. And if you look at the beta, it's about 1.39. That's like 40% more volatile relatively. So it is a very, very volatile fund. So don't assume that this fund is less volatile. Of course, if you look at the category beta and the category standard deviation, it's very high, but that is so relative, because if in the category there have been some credit rating downgrades, then that will affect the NAV. So don't look at the category measures too closely here. You have to measure it with a benchmark. And the benchmark for this fund is CRISIL Liquid and CRISIL T-bill 1-year treasury bill index. Both of them are completely inappropriate indices, and this fund is significantly more volatile than those indices. So don't go by that. The next thing I want to show you is the maturity profile of the bond. Many people will tell you to invest in ultra short-term bonds for a few months and above. But if you look at this fund, up to 12 months returns, up to 12-month duration bonds are significant. But there are also, look at the orange patch is 1 to 3 year maturity bonds, and that is a good 20 to 30%, and in the last couple of, in the last year or more than that. So if this is not a short-term bond, you have a bond fund, you have to invest in it above 1 year. Minimum is 1 year. I would recommend even more than that. And this is the kind of credit rating profile. Look at the A1, the top quality bonds are A and AAA. The AAA is here, and they are both quite low. It's dominated by AA and A. So you have to be very you mentally prepared for this AA becoming A, and this A becoming double B or triple B or whatever it is. And notice the type of bonds that it has been holding. The corporate debt has been significantly increased in all of Franklin Templeton's debt funds from middle of June 2012 as a policy decision. I don't know why, but not of course, with the exception of 1 or 2, and that's this fund is no exception for that policy decision of increasing in corporate debt. It is full with corporate debt. Be careful. So that's what I talked about earlier, and come back to this. So this is the the expense ratio evolution. You can see the blue is the expense ratio of the regular plan. This is the direct plan, is in orange. You can see how the AUM, the red line is the AUM. The AUM is shown in the right axis. As the AUM is increased, the fund has a big jump. They have taken big jumps and increased their total expense ratio, which is terrible. SEBI should do something about it. They have been tinkering with this total expense ratio too much, and I somehow feel that's simply not acceptable. You can see here when the AUM dropped down a little bit, they increased the expense ratio just to make sure the profits are the same. This is something that the funds have been doing for a while, and simply not acceptable. So only investors who can handle this credit risk, who understand the credit risk, not just people who say, oh, I have a lot of risk appetite. Only people who understand the credit risk, who track the portfolio carefully, should be able to should invest in this fund. Do not look at the star ratings. Do not look at past returns. Do not assume Franklin Templeton funds will get away with credit risk. They will not. They have not, as I've shown you. So please use it only for 1 year and above goals. Long-term goals also you can use if you have the right mentality. um, Growth option will work, but if you are worried about the credit, if you want to reduce your risk to the credit the credit profile of the fund, you can choose the weekly dividend option. Then some dividend will be paid. Then of course this will work only if you are on the 30% slab. The LTCG or STCG for a weekly dividend option will be close to zero, and you don't need to pay any tax on the dividends. They will have a dividend distribution tax from your gains at source, which is close to about almost close to 30%. So that's one way to lower your risk. But if you want to keep it simple, choose the growth option. So that's what I wanted to say about this fund. Please be careful. I'll catch you again in another video. If you have any questions, comments, please leave them below. Bye bye.